I think that Asia Pacific is just a few years behind where the United States is and Europe. So, Asia has its challenges. Europe is one big market. The United States is one big market, and the regulators have mandated competition in those markets. Asia is a whole bunch of different countries, each with their own regulators. Lots of monopoly exchanges in this region. A lot of mandated non-competition in these regions. But again, I think that it's a competitive issue. Regulators have to understand that they can be a bottleneck to capital inflows, or they can be an enabler of those capital inflows. The more expensive it is to invest in these markets, the less investment they're going to get. That is where regulatory arbitrage can come in. So if I know that historically there's been a lot of competition between Singapore and Hong Kong. If Singapore opens their markets and the regulatory structure and makes it more efficient to trade, then all things being equal, you're going to see a lot more money flow into Singapore, and you have, right? So hopefully competitive issues are going to open up the markets for competition, bring down the overall trading costs. We're going to see the implementation of what best execution means. This all takes time, right? But the opportunity really is the Great Rotation, right? The Great Rotation hasn't really started yet, but it's going to start once interest rates start rising. And we've seen just when the Federal Reserve started talking about quantitative easing, the massive amount of money that flowed out of fixed income just in a very short period of time. So we've seen $1 trillion flow into fixed income funds from equity funds over the last 10 years. And that was great, and it was good returns. But we know that interest rates are going to rise, and we know that when they do, fixed income funds are going to decline in value, and all these people that put their money into bonds are going to start seeing red on their statements. The equity markets have performed extremely well over the last few years, and normally that's enough to entice the retail investor back into the market. To date, they still have been sitting on the sidelines, and there's a massive amount of wealth creation that's been missed just because they've been sitting on the sidelines. But you can and you should expect $1 trillion to come back into the equity markets, to flow back from bond funds into the equity markets. And quite frankly, that is the opportunity that every market should be looking at right now and should be gearing itself up towards. So the more efficient they can make their markets now, the more opportunity they're going to have to get some piece of that $1 trillion over the next few years. And I think that if the regulators understand that, if the exchanges understand that, that's what they should be working towards.